This video is simply about ranges. What I see, how to see candles in the sense of a range, essentially. So, what I mean by that is that everyone looks at candles as a candle, but what actually a candle is it's deciphering information that has been created by the price movement of that time frame. So, obviously, 1 hour time frame, 4 hour time frame, daily time frame, whatever the time frame is, that candle is used to decipher and utilize the information that's been created to then make it into a way that basically the data is easier to read rather than just looking right every single second this was where price was and then just having a bunch of numbers. That's not really possible to kind of trade through. But what you can do is obviously you can look at it in the sense of, right, well, if this is the high of this time period for this candle, then it's obviously something has stopped it from going higher. Something has stopped it. So what I see ranges as are liquidity. Now there is this kind of thought process of all hate the retail traders and bringing like what they do is not worthy, etc. And to me, everyone that trades that's not in a bank or a hedge fund is a retail trader. And to me, even the people that do trade in those kind of areas, they are trading in the sense like they're not. The forex market is not big. Like no one's big enough to really on their own move things. They have to be in a group. Like right now, we have US dollar news. This is a time where it makes sense for the like multiple organizations to be thinking in the same way, which is then going to cause this kind of movement. Now, this is the kind of movement that actually I don't really want to be a part of. It is very impulsive, but to me, I just let these kind of things happen, and then the trends that come on the back of this is where I make the pips, the profit that then allows me to continue doing what I'm doing. I don't need this necessarily big push. Of course, if I'm part of it, then so be it. That's not something that I'm going to say no to. But yeah, that's just something that I want to kind of put out there. So what should you look for in terms of liquidity? Now, I don't look at it in an overcomplicated way. I essentially see that liquidity is not what most people think it is in terms of, oh, people are like the retail stops, etc., and all that. The banks don't care. All they care about is the best price that they can get for that particular session, for that particular day, that then allows them to then get the best price to make the most money for them and their clients. It's not, oh, I want to take out Bob, Joe, and Harry or whoever it is, take them out before then I turn around. No, that's not the case. The banks aren't out to get you, they're just out to get the best price that they can without breaking significant structure to then actually change the dynamics of the of the currency pair. So a great way to look at it is the previous days high and low are areas of liquidity. Once price takes out the previous day high or low, even if it's trending, unless it's very, very strong trending, expect a pullback that lasts at least a 1 hour candle. That would be my kind of default. Um, that's like even if it makes a break and retest, etc. That would be that's what I focus on. And in terms of right, well, we've taken out the lows of yesterday. We're in a downtrend, but I expect some kind of pullback. I expect some kind of reaction before price then either continues in the direction. that I thought. Now, a good example is euro dollar today. So euro dollar, this was the low of yesterday. Now price is taking that out in the 9 till 10 kind of candle, taking that out, but then actually we've then pulled back for a solid hour, came back into the break and retest area, given some evidence to look for shorts again, and then we've actually failed to make a new low. We did make a new low an hour or so before the big news event that's just occurred. But you can see that every time that price makes a new low, that it's pulling back. Now, these are areas that you can look for reversal trades. So reversal trades in line with the trend or against the trend, whatever you wish to do. But they are areas that you should aim for as targets if you're in a trade or as possible confluences for trades. Now, for me, I actually took long euro dollar today. Now, obviously, I've taken most of my profit off and the rest got stopped at break even. That's just the way that it is. It's the same as my previous video. I'm still in part of euro yen, which was going very nicely and then has turned around a decent amount again after this news. But why I was looking for longs was we have this 4 hour area from 8th of February and then here and then it was here, then we broke through it and then I felt like this big push up had then gone back up above this area and broken some structure on the way that it has, that it was able to get beyond this area. And then obviously we pulled back and we slowed right down in this area. So I took an entry around 1.2028 and I took most of my profit off at the resistance that was created by the break and retest, and then it was then confirmed by this candle that I know a few of you that I work with managed to get shorts for a break and retest. Very nice trade down into the lows of the day at the time. Now, that is why management points are key, because as you can see, we actually did turn around. I got some of my profit, and now obviously with this news, it's just dumped. But as you can see, the 4 hour here, like, mark out or be aware of the high and low of the previous 4 hour. You can see here this current 4 hour took out the highs of this 4 hour and then has turned around. Now, to me, that's not to get retail traders into a trade, into a buy. If they've entered long, for example, they've seen this candle close, they've entered above the highs, put their stop loss below the lows, and it's a rather large stop, and that's the way that they're going. Now, there will have been a lot of people that have traded like that, but I don't feel that the banks are out to get those people that did that. That's not their point. They obviously have the feeling and knew the news event prior. They were like, right, well, we know it's going to go short. We know it's going to go down because of the speculation, because of what's coming out of the meetings pre. Like they have obviously insiders. They have people that they can contact and be like, well, look, here's the kind of minutes for this meeting, here's what should happen, and then they're going to work with that to then create a judgment and then take the trade. So what they've then done is broke price up to just above the structure area that price wasn't able to close beyond, and then it's just absolutely turned around and dropped. And you'll see this constantly. Now we're down at the lows of the 2nd of March, so we will have a reaction off of here. Now, I wouldn't be looking to enter personally because of the time of day. I feel that if I was to enter these kind of trades, the best time to do them is whenever there's the most volume in the market, because that's whenever price is most likely to reverse. We've got NFP tomorrow as well. You can see here, this was London session, and then it just rose for the rest of the day, which is from this area. So that also comes down to the timing of your trades, the time of day that you trade. You don't need to be trading whenever the market is starting to die down. There's a reason why this has happened. And because of the news, it's happened, but then it's also the volume. Everyone's got out, done their trade, and now it's like, right, just going to let things lay for the rest of the day, let the daily candles close, and then come back tomorrow. Now it's NFP, so I imagine there'll be short, sharp bursts in the morning, and then it'll probably die down around 11 o'clock until half one whenever NFP's done. NFP isn't what it used to be in terms of news catalyst, but it still is something that I feel traders are wary of. Therefore, they kind of don't like. There's less volume, there's less trend, there's just less of a movement on a Friday on NFP, due to the fact that people just don't want to be involved in the market at that time. So yeah, if you just imagine a candle and like work on it, especially on the 4 hour and the daily. The 1 hour as well, yes, if you're trading lower time frames, but the 4 hour and the daily is enough to be aware of. So obviously you've got your high and you've got your low. Forget about the wicks. The wicks do matter. They are part of it. Obviously, your ultimate high is the high on the wick, but I just want to talk about the body. So within the body, so within the range, well, actually, let's just do the wicks because technically it is the whole range is including the wick. So that's it. I better just do it properly. So let's make that one. Okay, so this is a fairly chunky candle. Now, obviously, it doesn't matter if it's up or down, it's the same kind of concept. Let's work that it is a buyer's candle to start with, so it's green. So you close here. You close here. Well, there's going to be a lot of sellers, etc., down in here. Now, price isn't always going to be able to pull back all the way, especially if price is in a strong trend. This usually occurs whenever price is more in a ranging manner on like an immediate momentum is more ranging on the kind of 4 hour daily charts rather than if it's in a strong trend then it can just keep on going and going. But if you see a candle like this, then it's like, right, well, what I want to do is I want to try and see if we can get at least 50% of the way back to then look for an entry before the push back up to the upside. So you're looking for price to come back into this area and then go long. Now, within this area, you're going to have like a 1 hour reaction, you're going to have a 15-minute structure area, you're going to have your stop loss that will be well protected without it having to be down here because you'll be taking a continuation trade that needs to just be protected by the last 1 hour or the current 1 hour, depending on the type of trade that you're taking and the time of the 1 hour that you're taking it. But it's just very good to wait, right? Well, I definitely don't want to be entering above the highs of this 4 hour candle because that's immediately the fact that you're buying high rather than buying low. But if I can wait for at least some kind of pullback around 30 to 50% at least of a candle range, then I can then be saying, right, well, I'm getting in at an area that can provide some value as well as technically make sense. So it's the same. It's the same with selling. You don't want to be entering below the lows of a seller's candle, a bearish candle, because you're entering below the lows. You're entering below the range. You're entering at a point that just doesn't make sense to get involved with the market. You're just better waiting for another hour or for another candle in that time frame to then allow you to like re-look at price, reevaluate, and then go again rather than forcing a trade. Say, for example, there's going to be people that have seen this strong bullish bearish candle, not seeing the fact that it's just created a new low of the day, and they're going to be entering here. Now, depending on when you look at this video, you can now go looking back and see the 4th of March, 5 till 6 p.m. Does price just keep on dropping? To me, I would say that it's probably going to come in here and then maybe for even an hour or so just around this area, but then it's going to get back above the round number and then just chill within here for the rest of the day. It's just going to have that kind of reaction because it's overextended in the market. Prices beyond the range low, which is the lows of the last 1 hour, and it needs to come back within because the volume's leading the market. You've already had a decent push, and it's done its main move. You can't always expect that price is just going to keep on going and going and going. Just be aware of your 4 hour candles, your 1 hour candles, your daily candles, and then what kind of pullbacks to expect whenever price takes out a high or a low, even whenever it's in a strong trend. That to me is what I'd say concentrate on from this video, so that you're not getting caught up in the fact that you know the bias, you know that it's in a downtrend, you know it's in downwards momentum, but you're getting involved in the market or you're getting stopped out before it actually makes its move. So you're kind of like hurting your trading advantage essentially. I say to the people that I work with that if you can get the 1 hour, the 4 hour, and the daily in the right way, in the right direction, in the right kind of format, you're marking the right stuff, you're seeing the structure, you're seeing the momentum, you're seeing the trend, you're seeing break and retest areas, you're seeing all of that, you're seeing when to leave a market, when to trade a market, key areas within the 1 hour, 4 hour daily area. Also, the last 4 hour and daily candles as ranges, because that's your most recent range on that time frame. That is a closed bar. It's going to be a range in the lower time frame anyway, but on that time frame, it's just obvious to you. If you can get that, and you can get that on a daily basis, you're going to be 70 to 80% of the way there to consistency in my eyes, because anything below the 1 hour, as I always say to myself and to people that I work with, is simply timing. I used to always be obsessed with the tightest entries and the tightest stop losses, but at the end of the day, people get them and they look cool for social media or whatever. But in actual fact, the people that are in the game longer, they understand that you don't need to get such ridiculous small stop losses, because at the end of the day, you're going to get burnt out in that way. You could do it for a couple of months, you could even do it for 6 months, you could even do it for longer. But the psychology of it, constantly getting break evens or losses because you're getting in one area too soon, it's going to affect your trading. It's going to affect your trading, that is then going to stop you from taking the better trades. And it just comes down to giving price that bit more, which is why I'm saying about 4 hour, 1 hour, daily areas. You just have to, and the candle ranges, you just have to be aware of them, respect them, and then try and use them in your stop loss placement and your kind of entry requirements in order to get the best possible price, or as close to as possible, with the most protected stop loss that you can for the trade that you're wanting to take.